All right, shall we go?
Yeah, let's get started.
All right, I know we got a lot to cover. So, good morning, everyone. Welcome to AllGen's quarterly updated market review. Today's April 20th, 2023. And man, do we have a lot to cover, both on different what's happening at AllGen as well as what's happening in the economy, markets, yada, yada, yada. So, I'm going to jump right in to what we're gonna to the discussion of today. Just as always, we start with the agenda and what we're going to be covering today. So we're going to have this is the introduction. Welcome. We'll jump right into Jason doing his market review and outlook. Then I'll do some AllGen updates, what's happening, and some maybe a financial planning tip if that might be relevant. And then of course the live Q&As at the end. As we move forward, understand that this webinar will be recorded. So if you miss anything here, don't worry. You'll be receiving a copy of the whole recording via email, usually within the next 24 to 48 hours. It is listen only format for you as an attendee, but use the Q&A button at the bottom. You can't raise your hand or anything of that, but use the Q&A button at the bottom of the screen to type any questions anytime during the webinar. We will reserve the questions till the end of the webinar, unless I feel as I'm monitoring them that there's something really specific to a slide that Jason's showing. I'll interrupt, but please feel free to shoot any questions that you have in there, and then we'll promise to do our best to get to all of them by the end of this webinar. So that being said, I will delay no more. Jason, please take us away.
Very good. All right, so we're going to start with a fun little design here, a little infograph, if you will.
Actually, you know what, Jason, may I interrupt you?
Oh,
you know,
yeah,
I was just reminded that we always start with some fun poll questions, and you know, of course, they would yell at me if I forget. I always forget this. So we're going to get you engaged for a few seconds. So the first question, lighthearted: what is your favorite TV sitcom? Seinfeld, Friends, Parks and Recreation, The Office, or The Big Bang Theory? Man, nobody put none of the above. That's okay. That covers most, I think, most people in this country. So feel free to answer that however you like. And then we'll take a look at the results. We have percentage-wise, The Big Bang Theory takes it away by a large margin, and I agree with that assessment. That's also my favorite. So call it the nerd in me. So we got one more question, a little bit more serious or finance related. This is interesting with savings accounts. You know, interest rates have gone up. So we always in financial planning say everyone should have an emergency fund. So we're asking, what interest rate are you currently getting on your emergency reserves? Less than 1%, 1 to 2, 2 to 3, 3 to 4, or greater than 4%. So let's see what the survey says. Most people are getting between 3 to 4. Good. I'm glad to see no one's getting less than 2%. 2 to 3. Talk to us. We can do better than that right now. You should be doing better than that. 3 to 4 and greater than 4. Very good. So that's one of the things that we've seen is as interest rates have gone up. Poo-poo to buy homes and all that kind of good stuff. But at the same time, you can take advantage of the higher interest rates by having your emergency savings, liquid, any type of liquid savings in higher yielding savings accounts these days. So if you don't know that, if you know anyone who could benefit from that, let us know. Happy to point them in the right direction. So now, Jason, please take it away.
Very good. All right, welcome everyone. Just for recording purposes, today's April 20th, 2023, and just want to get us started on a fun little graphic that our marketing team made that I think does an excellent job of kind of explaining the emotional roller coaster that people go on when investing. And there's a lot of truth to this graphic here, and it's important to understand this because it's going to cover a lot of what we're going to talk about. At the same time, it is the reality. Just to understand how the chart works, as you see this line right here, this represents the stock market, okay, the roller coaster, if you will, and then each emotional point of the roller coaster. So, like for example, as you're going up, you're optimistic, then you start to get excited when the market's getting higher and higher. There's the thrill of your stocks going up and making money, and then you reach this point of euphoria. And that's usually at the point of maximum financial risk, is when you reach that euphoric point. And that's because you think the market's going to go higher. And you think there's really no chance of the market falling, which if you think through that logically, that means most people have already bought. And there's a lot of potential sellers now because all cash has been put in the market if you think it's going to go higher. Well, that was probably what we saw around November of 2021. And kind of leading up to that was that point of euphoria. And then the market started falling the beginning of 2022. Initially you feel some anxiety and then there's some denial. No, the market's going to bounce back. It's going to be fine. Then as the market goes even further down, you're starting to become fearful. Then you start to get depressed when you're looking at your account. Then people start to panic and eventually they capitulate. And capitulation basically just means that you're throwing in the towel. You give up. You're calling uncle, mercy. I want out. Get me out. And then you reach that despondency at the lowest point. And that actually, from an emotional point of view, is usually when people sell. However, it's the opposite of what you should be doing because that's the point of the maximum financial opportunity. So I point this out to understand that, right now, for the most part, the people that we talk to are pretty concerned about the stock market, and rightfully so after kind of what we went through the last couple of years. So I'm going to come back to this chart in a second, but let me show you what the actual stock market looks like. And this is the S&P 500 that we're looking at. This over here on the left side is the low that occurred back in March of 2020 when the pandemic got really bad. And then you had this really strong upward move in 2021, 2022. They were doing a lot of stimulus. Interest rates went down to zero. People were getting stimulus checks at the same time, so a lot of cash. And then in November, kind of December of 2021, we reached that peak point. But people were really excited about the stock market at that point. We were getting a lot of calls that people wanted to go more aggressive around this kind of late 2021 point, or people wanting to invest for the first time. And unfortunately, that's kind of the tendency with markets and with emotions, is that when things look really good, that's usually when the highest risk is. And it's because there's complacency. You don't think the market's going to fall. Well, then fast forward, you went into 2022, inflation started to rear its head. It started going higher and higher. The Federal Reserve, noticed this and started raising rates very aggressively. And so the stock market started to fall. And people started initially, there was some fear, and then you had this little bounce here, and they're like, it's going to be okay. It was just a bounce, and then it goes even lower, and people start getting more scared. They start to panic. And then at this point, we had a number of calls sometime between September and October. And we actually have really good clients that kind of have that long-term view and are very wise investors. But we do still have people that get very nervous and give us a call. And that's okay. We're here for you. But at the same time, we got a lot of calls in kind of October of 2022, people kind of reaching that panicky point, that capitulation point where they're they don't want to see their account go down anymore. They want to get out of the market. They want to go to cash. They want to go to money markets. And then fast forward to the last couple of months, as we start this year, the market started to break out of the downward trend line. That's what this red line is indicating, a downward trend line. So the market right here broke above that. And then it went back down, tested it one more time down here, held on, and now it's continuing to go higher. And we've had actually 3 consecutive higher lows and a multiple consecutive higher highs, which is, and from a technical analysis standpoint, that's the definition of a upward trend. So no one knows the future. We don't know the future, but from that is a pretty optimistic sign. That's a pretty good sign so far that the market is starting to do that. Let me go forward one more slide and I'll relate this back to the roller coaster again. So this is the panic euphoria model. Okay, a little bit of a busy slide here, but on the top part we have the S&P 500 going back about 40 years to the 80s, and in the bottom part there's a sentiment indicator. It's actually multiple sentiment indicators that would show when people are panicking, and then they show when people are, so below the green line is when there's people panicking, and above the red line is when people would be complacent or euphoric. And you can see, just visually, every time we've gotten to that panic point, it's been near the bottom of the market. And just statistically, if you look here at the very bottom of the slide, 1 year later, when we've reached this panicky point, the market's been up 94% of the time. And that on an average returns 1 year later are 17.86%. So we reached that point in October. Even again at the beginning of the year, we reached that point again. So there's that panic point, and there's numbers that will show that. So going back to this chart, I think we're somewhere around kind of this area in terms of the emotional roller coaster, where people are somewhere between still pretty concerned about the market, thinking it's going to go a lot lower, but the very kind of initial moment of some hope. So I think we're somewhere in between this phase right here of the market. So to further make this point, super busy slide, but just so you don't think we only saw one little indicator and then that points to, you know, a good chance the market may have bottomed in October. This is 4 other sentiment indicators. I'm not going to get into the details of each one, but every single one gave a similar signal back in October, which pointed to high panic levels in the market, which historically that does show that the market usually has pretty good returns for the next 1 year. So from a sentiment standpoint, looking somewhat positive that we did kind of flush out a lot of the weak hands from that panic moment, which allows the market to go higher a lot of times. So this is another indicator. It's different. This is more of a momentum indicator. So there is an analyst called Martin Zweig, who is famous for this indicator called the breadth thrust indicator. And without getting into the technicals of the breadth thrust indicator, breadth in general means the majority of the market if there's a lot of market participants. So for example, you know, if the market's going up but only a few stocks are leading the market, that would be bad breadth. Okay, we don't want bad breadth. But if you have a lot of stocks going up at the same time, that's good breadth, and that shows strength. So we just recently got an indicator, and you see each time in history when we've had this indicator that there has been very good breadth behind this recent rally. And 100% of the time when it's given this indicator 1 year later, on average, markets have been up about 24%. So that's also encouraging. So there is some hope from the stock market standpoint. And while, you know, a lot of people may not think that's possible and think the market's going to go further down, we're seeing a lot of indicators that show that there is a good chance the market may go higher. Obviously, we're not 100% sure that no one knows the future. The economy is still struggling quite a bit, which I'll touch on. But you always have to remember that the market leads the economy. There's a very good chance, flipping back here one more time, that when the market went down here in 2022, that it was predicting a recession. So the market can do this, and then we believe actually we're in a recession right now. If you look at a number of indicators, they're contractionary, especially if you look at manufacturing. So we believe we're actually already in a recession. So the market went down anticipating that we were going into a recession. The market can do the very same thing the other direction. So it can start to go up before the recession ends, and that's typically the case. So what specifically we like on the stock side is, well, let me give you some history and how this chart works. So this is a chart that measures value versus growth. So when the line's going up, value outperforms. When the line's going down, growth outperforms. From 2000 to 2008, you had a really strong outperformance by value, and then you had about a 13-year outperformance by growth, which bottomed out in late 2021 at the top of the market. At that point in time and all throughout last year, we started getting very heavy into value stocks. And so you can see, you know, as value stocks at the beginning of 2022, they started rallying much higher. In fact, value stocks led growth stocks by 25% in 2022. And we were very overweight in value stocks at that point, which really helped our portfolios hold up in a difficult market during 2022. Well, something recently just changed, especially, and it further expanded when the whole banking crisis started popping up with the Silicon Valley Bank, where when that happened, the Federal Reserve kind of halted or paused or even slowed down their federal rate increases, the pace at which they were increasing rates. And it now looks less likely that they're continuing to raise rates going forward. And they maybe have already peaked, which I'll talk about the second half of the presentation. But the point of me saying this is that it looks more optimistic from the standpoint of the Fed not tightening as much. And when the Fed starts to lower interest rates, that is more stimulative. And that also tends to favor technology stocks. And so you can see just recently at the beginning of this year, technology stocks have started to outperform again. Remember when this line's going down, this technology stocks outperforming, and it broke a short-term upward trend. So we think at least if interest rates are going to continue to come down as we go towards the end of the year, technology may start to outperform again. So we have evened up our portfolio, sold some of the value stocks that we were overweight in, and brought it back into alignment where we now have equal weight growth, equal weight value. So that's one thing that we're noticing. Another thing we've been talking about for a couple of years that we thought there's a good chance of this happening, but we believe international is going to start to outperform, and I'll talk a little bit. It already has started outperforming, but we think it's going to be for a period of time. So the way you read this chart, when you see this kind of purple mountain chart, that shows international outperforming, and then when you see the gray portion, that's domestic or U.S. outperforming. So you can see it kind of pendulum swings back and forth between international and U.S. stocks over time. And there's been some periods of some extreme strength in international where, from the late 80s, they led by 300% over, a 5-year period. And again, they did from kind of 2000, 2007, they led by 65%. And that was even higher for emerging market stocks at the time. But then you see this massive outperformance by US stocks for the last 14 years. Well, just recently, you started to get outperformance by international. They led last year, they outperformed last year, they're also outperforming this year. So we've been shifting, we were very underweight international, especially towards the second half of the underperformance of international, and we've been adding back into it. So technically it's starting to look better. As you can see here on this chart, the same thing that we did with value and growth, this is with international and US. As the line is going up, international is outperforming. As the line is going down, US is outperforming. You can see a trend break here, a very long-term trend that recently broke, showing that international is starting to outperform. So technically, international looks better from a charting standpoint, from a momentum standpoint, but also from a valuation standpoint. This is a chart we've often referenced over the last couple of years that leads us to believe that international will outperform for a decent period of time. This shows the valuation, the price to earnings discount of international stocks to US stocks. And there's about a 30% discount in international stocks compared to similar US stocks. So that's at about a 50-year low. Just recently in last year, we reached 50-year lows in that discount, showing that value stocks are very cheap compared to US stocks. And on the right side here, a similar metric, but showing dividends. And when dividend yields are higher, that shows greater valuation. So we passed the second standard deviation where dividend rates for international stocks were significantly higher than US stocks. Right now, dividend yields are 1.6% higher for international stocks than US stocks, which shows both of those indicators show that from a valuation perspective, value looks better or it looks cheaper right now compared to US stocks. And then switching gears into kind of more commodities and looking at the dollar as well here. One of the other changes or something that you should understand with interest rates is when the perception is that interest rates are going to start to go down when they've come close to peaking, then dollar will start to weaken. The dollar and interest rates are very correlated. So as interest rates went up in 2022, the dollar was very strong and went up at a quick rate. But now in 2023, interest rates look like they could be topping soon, and they're going to start to go down as we go into the second half of the year. So the dollar, represented by the blue line here, is getting weaker. And that really started to happen once the banking crisis came about. At the same time, there was kind of a flood to safety. So the yellow or gold line here represents the commodity gold, and they're inversely correlated. So as the dollar goes down, gold goes up. And you can see this year, this has been one of the best holdings actually this year. Gold's up 12%. So now I'm shifting from kind of stocks and commodities into the Federal Reserve, interest rates, and fixed income side of our portfolio. And this chart right here shows you the different interest rate cycles that we've been through in the last 40 years. And the axis on the left here shows how high the Fed's rate changed. So how many percentage points they raised interest rates. And then on the bottom axis here, it shows how long it took for them to raise rates. So you can see this is the cycle that we've been on over the last 1 year, and the Federal Reserve has raised interest rates extremely fast compared to the last cycles going back 40 years, and they've gone higher than any other time in the last 4 years. So that, if you understand how bonds work, when interest rates go up, bond prices go down, which led to one of the weakest, or actually the weakest bond market of all time in the U.S. We're going to point out here in a little bit that we believe this cycle is getting close to an end, and that the Federal Reserve has potentially stopped. So if we look here at the blue line, this shows the history of almost the last 10 years of the Federal Reserve raising rates and lowering rates. This is where we came from in 2021 before they started raising interest rates, and you can see how massively they raised those interest rates. Well, prior to the banking crisis is this red dashed line. This is what markets were predicting interest rates will do, the federal funds rate will do over the next year, and towards the end of the year, they were predicted to go much higher. In fact, at one point reach about 5.5%, kind of in the year around 5.25%. Well, now you can see the predictions are that they're probably already come close to peaking. We think there's going to be maybe one more rate hike, and then they will peak, and then they'll start to go down kind of September through the rest of the year. And actually, this is predicting that interest rates will be down near 4.25%. And just to give kind of a reference, right now we're right at 5. It's actually 4. They do ranges now, so it's 4.75 to 5. So this, you can show a big shift from where we were to where we are now. That would be good for bonds, and that has been good for bonds. But one thing before I touch on what the bond performance side of things, the one thing that has caused, well, actually there's two things that have caused inflation to stay high, which has caused the Federal Reserve to continue to raise interest rates. And that's kind of the core portion of the CPI. So the CPI index, is a broad measure of inflation. The blue line is, the larger inflation measurement, where core takes out food and energy. Food and energy are a lot more volatile. So the core would take that out to exclude that. But you can see we have reached the lowest point in almost 2 years in inflation, according to this measure, from all the different things that make up inflation. But core has been a little bit more sticky recently, and it's kind of stayed. It hasn't dropped down much lower over the last couple of months, and that's what's kept the Fed continuing to raise interest rates, even though inflation has started coming down and peaked really kind of early mid last year. And the big component of the core inflation is housing. Housing is one thing that causes inflation to be or the core to stay higher, and that's kind of a little bit more sticky because it takes a little bit more time for the housing market to kind of come back down, and rents have increased, home prices have increased. So this shows you kind of what on the housing equation side of the CPI, or just inflation in general, this is what's called owner's equivalent rent. So basically, what people are paying for rent, or what people are paying for even mortgages, what you're paying for having a home, having a place to live. It's been growing year over year at about 8%. And you can see over the last almost 10 years, the typical rate of growth is closer to 3%. So the fact that that people's rents and people's mortgages have been going up, that's a large portion of someone's budget, and that's a large portion of the core CPI, and that's been a little bit sticky. You can see it's starting to level out right now. In fact, if we look at, this is the Case-Shiller 20 home prices index, basically takes the largest 20 cities in America and then looks at the housing prices of those cities. And you can see, we were growing at 20% year over year growth in 2022, and that's where we peaked out. But now we're at the same level that we were kind of even before the pandemic. In fact, longer term history, we're below growth rates that we were over the last 10 years. And home prices are only growing on average across the US in these 20 cities at about a little over 2%. So certainly the housing market has started to slow down pretty significantly from a price growth standpoint, which is encouraging from the standpoint of inflation. So you got housing as the main sticky area, and then you got wages, which I'm going to jump into here. So So it hasn't really, even though we believe we've been in a recession, hasn't really felt like a recession because unemployment's been so low. We've reached literally 50-year lows plus in unemployment. It's got down to 3.5%. But if we look here, this is the 4-week moving average of continuing claims for unemployment. So when people file for unemployment and they continue to file for unemployment, this is a measurement that would kind of show people still maintaining their unemployment status. And you can see right after the pandemic, it shot up, went really high. Then people got back to work and actually the job market became super strong. But now you can see if we zoom in here, this box is zooming in at the end, unemployment has actually got to the same point it was more than a year ago at the end of 2021. So you can see it starting to kind of turn a corner here and unemployment claims are going higher. While we don't wish anyone would lose their jobs, the fact that unemployment is going higher, that is helpful for inflation to come down. Because when there's a very tight labor market, it causes causes employers to have to pay more. And that wage inflation is a very sticky component because when people make more money, they spend more money. So this is one more indicator showing job openings. And if you're really into the industry, they call them JOLTS. But basically the job openings, at one point in 2022, at the peak here, you had 2 job openings for every 1 person looking for a job. And so that has started to come down recently. And again, we're at about 1.5-year lows and trending down. Still more job openings than people looking for jobs, but that ratio has gotten a lot better, which will help from a wage inflation standpoint. And this is kind of looking into different sectors of what's been hurt the most. I mean, a lot of people would understand that information, we've heard a lot of information technology or the technology sector, a lot of layoffs in technology. In fact, year-over-year growth in job openings for technology is actually down 42%. And you can see pretty much all these different sectors have had negative year-over-year job openings. They've been declining significantly. The only area that has shown growth is mining and logging, which would kind of point to some of the inflationary things, gold being higher, silver being higher, a lot of commodities, oil being higher. So that's been the only strength from a job standpoint. And all that to say, if you have less job openings, okay, and unemployment starting to get higher, then employers aren't forced to pay much higher. We're still at a very high level historically. So this is showing you average hourly earnings. And we were getting above at one point, or the last couple of years, above this 5% line, which is a super high level. And in historical times when wage growth has been that strong, it's led to really high inflation. So kind of more what we've experienced over the last 10 years is somewhere between 2 and 3%. So we still have a ways to go before we get to that point. But it's encouraging to see we're back down to where we were in September of 2021, to kind of second half of 2021. So that's moving in the right direction from the standpoint of helping inflation go lower, which would then allow the Fed not to be so tight and not continue to raise rates, which would hurt the economy. So this is the yield curve, if you look at it here. And what this chart represents, these 2 lines, is where yields were at the end of 2022 across the curve. So you have short term over here on the left, and you have long-term 30-year bonds on the right. And then each one of these little squares here represents where the yields were at the end of the year. So you can see yields have come down this year. In fact, as of April 12th, this is where yields were, and they've dropped significantly. So remember again, that inverse relationship, when yields go down, bond prices go up. So that was the opposite last year, which with this shows where you saw interest rates go up at an extremely fast pace. And bonds, this chart showing you all the different kind of categories of bond. The aggregate bond index, this one right here, represents kind of the entire bond market, and it was down 13%. That was the worst bond market year in U.S. history. The worst year in the last 50 years, that same index was only down 3%. And then as you went longer term on interest rates, 20 plus years in Treasury bonds, that was down 33% last year. So bonds experienced a massive drop last year. In fact, the only part of fixed income that was up was money markets. But here's the problem, and going back to kind of where we started with the whole kind of emotional roller coaster. When people see this and they see their accounts are down a lot and they see their bonds are down a lot and their stocks are down a lot, they have the tendency, and this is how we're wired as human beings, fight or flight. It's really hard to fight the stock market. So you tend to flight, you tend to run away, you tend to sell. And so what a lot of people did, and we're okay with what they did from the standpoint of their emergency reserves, but they went into money markets. You should try to make as much money as you can in your emergency reserve account. We're all for that. We encourage that. That was one of Paul's survey questions. But when everything goes down and you panic, that's not the time to go to cash in your long-term investments. In fact, that's usually the highest opportunity for financial gain. But everything inside of you psychologically is telling you to run for the exits. So let's fast forward in the same chart to next year. So this is all the returns just through the first quarter of what bonds have done. Here's the overall bond index up 3%. Again, that's just for the first quarter. That's not an annualized number. If you were to annualize that, that would be at a rate of 12% growth. Okay, and then you have 20-year treasury bonds up 7%. What's the worst performing this year? Money markets. And that's people's tendency. They tend to want to run to the safety at the worst time, and then they end up locking in a very low return. And it's hard, and that's why we have these webinars to teach you guys to try to kind of avoid making fear-based decisions and stick with the process. Know that we're trying to protect and we're doing everything we can to protect your portfolios, but at the same time, when things sound really bad, that's usually a good time to invest. So just wanted to point that out. Bonds have been doing really good this year. We really think bonds will have a very good year. They already have had a very solid year. And we've increased our duration, which means we've bought more of these longer term bonds. And we started doing that in October last year. We've done it a little bit more recently. And so, shifting more to thinking that the Federal Reserve is probably close to done raising interest rates, and we're going to start to peak and come lower, which that would be good for bonds. And markets, again, they're forward-looking mechanisms. So a lot of times yields will go down and bond prices will go up prior to the Federal Reserve stopping raising the rates. They'll do it before that happens. And so we have to know that and start to, kind of position ourselves ahead of time in anticipation of that happening. So I end my part of the presentation on this slide, and this is kind of bringing everything together and pointing out just what a diversified portfolio has done over the longer period of time, and kind of showing, in the green area here, this is stocks, and the blue bars represents bonds, and the 50-50 portfolio is a balanced portfolio. So you can see, going back 50 years, stocks have definitely had the best return. They've averaged 11.1%. Bonds have averaged 5.5%, and then a 50-50 portfolio has averaged 8.7%. But if we look at it from a short-term perspective, so any 1 year time period, going back all the way to 1950, you can see the most volatile is stocks. Their best year has been a 47% gain, but their worst year was down 39%. And then you see bonds, much less volatile, but still volatile nonetheless. Their best year was 43%. The worst year happened to be last year, was down 13%. And then if you look at a 50-50 portfolio, from a 1 year standpoint, its best year was 33%, its worst year was down 15. That down 15 happened to be last year as well in that portfolio. So, but go to a little bit longer time frame, okay, a 5 year time frame, and the worst 5 year time frame for stocks was an average loss of 3%, and the worst 5 year time frame for bonds was an average loss of 2%. And by the way, that's this last 5 years for bonds. But if you look at a 50-50 portfolio, 50% stocks, 50% bonds, in that's 72 years, that portfolio has never had a losing 5 year period. Its worst 5 year rolling period was an annualized gain of 1% every year. So I point that out because, sometimes people can get very nervous in volatile markets, and they can sell when markets are down. And that's obviously the wrong thing to do, but it's everything inside of you is pointing to doing that. You're wanting to do that. You're wired to fight or flight. But if you just hang in there, sometimes you can end up, the market tends to come back and things kind of right themselves over time. Another reason I point out this chart is some people are really pessimistic about the long-term future. And let's say they've retired and they're taking money out of their portfolio. And they're going to wonder if their portfolio is sustainable, over the long term, if we go into a really bad market. Well, if typically, people that are retired are closer to this 50-50 kind of balanced portfolio. And if you go to, let's say they retire at 65 and go into a 20-year period, and you look here, the worst returns over a 20-year period were an average return of 5% for a 50-50 portfolio. So while those aren't great returns by any means, a lot of people don't envision that when they think about a very difficult future. They're thinking about, you're going to have losses indefinitely going for a long period of time. And that's just hasn't been historically the case for a longer period of time. So the market will do its thing. It will go up and down, but usually over time, especially if you have a decent money manager, you can have pretty decent returns, even in a difficult time. Even if we go into a higher inflationary time, a stagflation time, kind of in the 70s that we went through, you can still have decent returns that can provide for some growth, assuming you're allocated properly, diversified properly, non-correlated assets, all the things that we try to do, rebalancing at the right times. So I just wanted to share that to you, kind of wrap here at the end, to kind of wrap everything together, just so you understand. I'm going to hand it over to Paul now. He's going to go over some updates as AllGen as a whole.
Very good. Thank you, Jason. And I know we've had some questions rolling in already. I'm going to encourage you to continue typing in any questions down there in the Q&A section. And as those continue to come in, I'm just going to give you some AllGen updates. We continue to grow, which is great. We're excited. We'd like to give a warm welcome or welcome back to Christina Schaefer. Depending how long you've been with AllGen, you may have seen Christina Schaefer in the past. She started her career with us after coming out of college from Rollins, their bachelor's in Rollins, then was recruited by Charles Schwab and relocated to New York, did a couple of years up there, but then felt she was missing the warmth of Florida. So came back here, and we are very blessed and happy to have her back here at AllGen. She is the new director of fixed income. So you can see her credentials there. So you'll see and hear more from her. So welcome back. And fun fact is that she's a native Floridian who actually loves skiing. She loves snow. So there's Christina. We also have we're growing and we're evolving. So we'd like to congratulate Ryan. Some of you may have seen Ryan as well. Ryan received a promotion, is now our director of trading and portfolio implementation. So he's worked in the investment management field for many years. He was also working at Schwab. He has a little incestuous thing going on with Schwab employment and us, but Schwab and AllGen Financial. Fun fact, Ryan has contributed to market blogs over a year with us now, so you may have already seen his blog. He's also a swimmer, I think a water polo player, so just kind of a well-rounded Renaissance man. So happy to have Ryan growing with us and contributing. Now, when I say contributing, you're going to see, if you haven't seen already, we have our dynamic portfolio investment reviews that we actually just released our first quarterly dynamic portfolio. It's video reviews of what's happening in the portfolio. So it gets a little bit more detailed than this quarterly market summary. It's what are we doing in your actual portfolios and what's happening, what we're seeing. So you should have received that already if you're in one of these dynamic portfolios. If you're not, reach out to us. We're happy to make sure you get the presentation itself. And again, you're going to be seeing these more frequently on a quarterly basis, as well as these monthly investment blogs. Christina just released her first one, I believe, not long ago, but she's also going to be releasing some more in the future. Our goal here, as you can see, we're beefing up the investment management team. Why? Not because we don't trust Jason can do a great job. He has been, okay. But, there's so much happening, with the globalization economies, all this movement, volatility. So we want to make sure that we stay abreast of everything that's going on and keep you guys better informed informed as well. Someone asked me the other day when I was doing a portfolio review, hey, what should we do in light of what's happening with the economy? And I was like, you mean, what have we been doing? Because, a lot of times, and credit to Jason and his department, they are actively moving things, and you don't always see all that motion. So it's not that we're sitting here and just waiting for stuff to happen. It's been a very busy quarter for them. So behind the scenes, and this is what the whole point of these commentaries are for, these updates, is to let you know what we've been doing, as far as shifting portfolio. And he mentioned one today, going longer term bonds, et cetera. So more growth stocks. So all this type of stuff we want to keep you informed of, and you'll be seeing these with the monthly blogs and the quarterly portfolio reviews. So if you see them around or hear them, give them a big welcome to Christina and a big congrats to Ryan. A little bit on a different note, more on the financial planning updates. The Florida Prepaid, many of you may have heard of this already. You or someone or a nephew or grandchild may benefit from this program. It's a tax-free way to save your favorite college expenses. Okay, you basically lock in college expenses at today's rates. Okay, so it's a good program. If it makes sense for you, you can take it with you, go to another state. If you go to another state, obviously it costs more, but you can at least get the inflated rate transferred over to another state if your child goes to school out of state. But enrollment ends at the end of this month. So you have approximately 10 days to get this going if it makes sense for you. Of course, this is not a blanket recommendation to go get a prepaid for you or someone you love, but check with us to see if it makes sense for you. We know many people have taken advantage of it. Sometimes it makes sense, sometimes it doesn't. So just want to make you aware that this deadline is looming. And then also, finally, we have our annual Money Sense Camp 2023. For those of you newer to AllGen, we offer a summer camp for high schoolers, for teenagers. It's no cost. We offer it every year to our teenagers. It's only a 3-day camp. And, a lot of teenagers are like, really, mom, dad, I'm going to go to a camp about money. But I can promise you, by the end of the camp, most of these guys are like elated. They're excited. They're ecstatic about taking charge of their financial future. In fact, some of them go home and hold their parents accountable to say, hey, what are you doing about your finances? So it's actually a very invigorating summer camp. So we literally almost shut down AllGen for those few days. Not totally, but we spent a lot of time, energy, and effort to offer this camp to teenagers because we want to hopefully make a dent on the woulda, shoulda, coulda if I would have known. So the younger you start, the better. And there's a big move towards financial literacy in the country, even in the state of Florida. So it's now open. Enrollment is open. The camp dates are July 31st, 1st, and 2nd, and it's from 9 to 4. So it's almost an all-day thing, like a school day thing at Discovery Church on Sand Lake. There is limited space because we only have so much room. I think it's like 65 students are available to join. We've had to unfortunately turn some people away the last couple of years, but feel free to use the link. It's if you want to kind of copy screen or type it down or write it up, but it's on our webpage. It'll be sent out, or just call us if you need the link, and you or someone can take advantage of this offering. So those are my updates. I'm sorry if I am seeming a little wired on coffee this morning. I don't know how many people woken up by this emergency alert testing system at a wonderful 4 o'clock in the morning, but yeah, we're here and it's okay. I don't know who programmed that, but okay. Let's get to the fun stuff. Again, feel free to continue typing questions in the Q&A section, and I am going to start. So with a recession looming ahead, is it time to start investing? Okay, in gold. Jason, you touched a little bit upon this. So tell us about this, like how much, and we've been hearing this a lot. People are saying, hey, let's get more gold. If the dollar's going to go down, shouldn't we do 100% gold? We've even had people say we want to go 100% gold. Jason, talk to us about that.
Yeah, absolutely. So we do like gold. We've actually been in gold since 2019 and have had some pretty good profits in gold. Gold as a whole is kind of right at that $2,000 level, which is kind of a resistance point. So this is kind of an area where let's see if it can get above that and maintain above that. That would be bullish for gold. Most of our portfolios are somewhere between 3 to 4% gold right now. We typically don't hold more than like 5% in gold. It is just, gold can be first of all, gold doesn't pay anything, it doesn't earn anything. It's an inflation hedge. or a hedge against a weaker dollar. So you would never want to put all of your assets in gold, because gold, it's not a company that produces earnings and profits, and doesn't tend to have, really high long-term growth rates. In fact, kind of gold's long-term growth rate is what inflation is. So it's about a 3% return over the long term. Now, in inflationary times, it can go up quite a bit. But there is a chance with the Federal Reserve raising interest rates so fast that in inflation now starting to come down, that if we go into a deeper recession, that inflation really comes down. And so we're not, you never can know for sure if any asset class is going to go higher. We like gold because it's a non-correlated asset, especially good to be able to rebalance between stocks and bonds. But we never want to hold too much in gold. But we've liked gold for a while. We own it now, so and we think the dollar is going to get weaker, so we think it's good to have a piece of it in your portfolio.
Okay. Someone's asking for a particular holding for gold in a portfolio. I think as you mentioned, we already hold gold. We're not recommending that people go overload on this, as you said, in their particular portfolios, and some are more tax sensitive to others.
Yeah.
But I mean, if you want to mention, these are our clients listening to us. I mean, we hold gold right now. How do we hold it?
Yeah, we do. So we actually own an exchange traded fund. Technically, it's not an exchange traded fund. Ultimately, it's what it's called is a trust. It's iShares Gold Trust. And it's not a recommendation to buy gold, but just to understand how that works, it holds physical bullion in an actual, in a trust, and the physical bullion is held in a vault, actually in London. So I think the wisest way to buy gold. A lot of times when you buy physical gold, like you see on those commercials that hear on the radio with the coins and all that stuff, you're paying huge commissions. A lot of times, at least a 20% commission for the purchase and another 20% commission on the sale. So let's just kind of throw some numbers to that. If gold right now is trading at 2,000 and you had to pay a 20% commission on the way in and a 20% commission on the way out, that's 40%. The gold would have to get above 2,800 for you to break even if you're buying gold coins or gold bullion directly through a broker. So we never recommend buying gold away, and you have to store it. So you either have to buy an expensive vault that you're keeping in your house, which is risk of getting stolen, or you have to store it at a bank and pay a fee. There's a storage cost to that too. Well, this fund only charges 1/4 of a point the way we do it. So 1/4% per year to replicate gold by actually owning physical gold bullion. We do have a little bit more too. So we own about 3 to 4% in gold, the actual bullion. We hold a little bit more, and I won't mention the actual name, so it's not considered a recommendation, but we do have basically a gold stock that gets royalties from gold. So we own another company, it's a Canadian company actually. So we do have some other investments that have gold in it. And if you want to find out about that, you speak to your advisor and they'll give you a little bit more of the details on that.
Very good. Thank you for sharing that. So another question that came in here is, I'm hearing American military assets are depleted. Is it a good time to invest in large military contractors?
Yeah, it actually has been since kind of the war broke out in Ukraine. We do own some of our portfolios that have individual stocks. Actually do own an aerospace company that has a lot of influence over military assets. And so that has done well recently. Also with some of our funds, we do hold some aerospace and defense inside of the different mutual funds or exchange traded funds that we own. So I do think that's a good place right now, especially if this war continues going forward. There's been a lot of military components, weapons, sent to Ukraine. It's depleted some stockpiles, plus just with the threat of kind of war in general, different countries around the world are boosting their military assets. So we think that's a decent place right now to be in. And we do own a portion in our portfolio.
Very good. Okay, this question came in actually before the presentation where you touched on this, but in light of the weakening dollar globally, should we consider foreign and emerging markets for safety? Well, that's an interesting word, for safety.
Yeah.
And how much?
Yeah, Paul kind of snickers a little bit at the safety comment, only because traditionally emerging markets especially have been probably the most volatile markets out there. But we do like them international and emerging markets. And, I'm showing this chart here where it looks like those are starting to outperform. And then technically international and emerging markets have broken out from their long-term downtrend of underperformance against US stocks. This would also play into a weaker dollar. So if the dollar continues to get weaker, and you own, companies held in other currencies, then that should benefit them as well. It's the same case, and we actually own some global bonds too, emerging market bonds as well. So if those countries' currencies strengthen against the US dollar, that would be good for those bonds. So we certainly do own and are well diversified in that way, where we own international and emerging market stocks and some international emerging market bonds as well. There's still, and it's gotten better over the years, but there's still, especially emerging markets, pretty volatile. That was one thing that hurt us a little bit, especially at the beginning of last year, when the war broke out in Ukraine. Some of those emerging market stocks, purely based out of fear, took a huge drop. Not even, I'm talking about outside of Russian and Ukraine stocks, but just, emerging market stocks in general, they took a big drop just on the fear of the war breaking out. And it dropped about 20% in about 3 or 4 weeks. So you don't want to own too much in that area just because of that level of volatility. But we're owning a lot more than we have in the past 10 years, because we do believe there's strength there, and we believe valuations are very cheap, and also lines up with the dollar potentially getting weaker. So that is an area we like as well.
Okay, very good. And just to piggyback off what you said about owning too much, these aren't safe investments. They're still, we use them as hedges, and where we think they have momentum going for them. So we expose our portfolios to the possibility of higher returns when these things happen, such as internet and gold. The same thing. Going back to gold, I mean, it's an hedge, and it's a potential good leaning towards performance in certain circumstances, but it's not a safe investment. I mean, I think it was in 2013, gold dropped like 28%, in a year, so, you have to understand that's just not all or none. People sometimes give us these extreme measures. I want to go do all this. But no, diversification still holds true for the steady plotting and the steady eddies to minimize the volatility, which can hurt a portfolio. Is that true, Jason?
That's absolutely true. And that's the kind of where I ended that last chart. Just the difference between having, a 50-50 portfolio over a 5-year rolling period. You went from, stocks having 3% a lot of, the worst year being a 3% loss per year for that 5-year period, to being diversified. Even though bonds had a negative, their worst 5-year period was a negative 2%, and stocks' worst year period was a negative 3% per year every year. The combination of both of them together actually had their worst time period was a positive 1% over the last 5 years. So there's benefits of owning both of them, because they usually don't go down at the same time. You have stocks that'll go down, and bonds a lot of times will go up. I know that wasn't the case last year, but historically that's typically the case. And we think actually that there is a chance of that happening this year too. If the recession gets really difficult, you could have stocks going down, but then the Federal Reserve is forced to lower rates and become more stimulative, and bonds could go up. And so that's typically how they work. They're non-correlated, especially US government bonds. So you want to own some of each. And the same thing can be said, where this is kind of really general, just kind of 50% US stocks and 50% bonds. If you start to add in some international and other components, even gold, that further diversifies and reduces that volatility, especially if a rebalance is applied.
Okay, and you mentioned, adding other components. What about, you mentioned a little bit about real estate. There's been a lot of talk about, is it the right time to get into real estate now that it's leveling off? It seems to be going down, even though interest rates are high. What are we thinking about using real estate as a diversifier in this type of portfolio, or outright as investment properties?
Yeah, so in the portfolio, we don't actually hold a direct holding in real estate. We don't hold any exchange traded funds or any direct stocks that are what are called real estate investment trusts, which is usually how you buy it in the stock market. We do have a small percentage in our overall kind of diversified funds. So we have, I think, maybe 1% to 2% in real estate. Real estate is tough from an investment standpoint in the stock market when you have high interest rates. And because when you have higher interest rates, a lot of these real estate investment trusts are very leveraged. and that can work against them because they're carrying those high debt loads, and as interest rates go up, that makes it more, they don't have as much profits, and that can put pressure downward. And the same thing, you can see just from real estate in general, that happens with real estate in general too. When interest rates go up, most people buy a home based off of how much they can afford per month. So when interest rates go up, that causes people not to be able to afford as much of a monthly payment, which equates to not as much of an overall cost of the house. So that's what puts downward pressure on home prices. I don't know if right now it's a great time to invest in real estate. This chart, you have to remember how this chart works. This doesn't mean home prices have fallen. They haven't. They're still increasing. In fact, they're growing at 2% year over year. This is just showing that we're no longer growing at 20% a year like we were in 2022. And the rate of growth has slowed a lot. Doesn't mean prices have come down. Just the rate of growth has slowed a lot. However, there are parts of the country, like in California and the western part of the United States, where on average, house prices are down 15% year over year. That's not the case in the Southeast, where we're at. Housing has still been pretty strong. We don't think right now is the ideal time. However, we're thinking we're going into a much better environment as we go into the next year ahead, especially if interest rates start coming down. And if we go into a recession, that could cause people to, not as many buyers as well. So you decrease that demand. It's still a pretty tight market in terms of demand to supply. We don't have the chart here, but if you look at typically the number of months that a house would stay on the market before it sells would be 6 months. That would be the average. And the pandemic, or actually kind of when we had this, crazy fast growing real estate market, it was down to 1.5 months. A house would only be on the market on average 1.5 months before it sold, which would show a very hot real estate market, definitely a seller's market. That's improved a little bit. We're at I think 2.3 right now, months but you want to see it start to get closer to that 6 and above that 6 to kind of show that it becomes more of a buyer's market. So I definitely don't think we're in a buyer's market right now in real estate.
Okay, very good. And another question we have, do you think I should dollar cost average my net proceeds from the sale of a house or lump sum invested, given the volatility?
That's a good question. I think last year we would have leaned more to the dollar cost average because as the market was falling, the dollar cost average works really well as the market's falling. I think especially if your portfolio leans a little bit more bonds, let's say that balanced portfolio or a conservative portfolio, I would go more lump sum at the moment if you sold a home, because we just came from the worst bond market in U.S. history, and rarely do you get those opportunities. So I think on the bond side of the equation, things look much better going forward. And I do see signs of hope on the stock side too. So if I'm just going to give a very blunt answer and not kind of be a gray area like I know a lot of financial people do sometimes, I would go lump sum right now with the sale of a real estate. But just to be the financial advisor would say inside of me, talk to your advisor. Let's look at your big picture. Let's see what else you have going on, because there may be some better ideas than putting all of that into the stock market. So that helps.
Very good. And then last question I have here before we wrap up is, I guess, talk to us about the dynamics of having a HELOC right now, given where interest rates are going.
Yeah, that's a good point. So, if you have a HELOC, a home equity line, those are almost always a variable rate loan. So, we've seen HELOCs right now where the rate is 7, 8, sometimes a little bit more, 8.5%. So certainly if you have a HELOC and interest rates are going up, that can make that loan a lot more expensive. In fact, a lot of HELOCs have nearly doubled in terms of what the payment was for the same amount of debt a little more than a year ago versus where they're at now. So, at AllGen, we're big time debt-free people, and we certainly encourage people to be debt-free. So if you can pay it off or be very aggressive and pay it off as quickly as possible, we would certainly encourage that. the potential light at the end of the tunnel, if you will, is that it looks like interest rates are peaking and they're starting to come back down. But you may not feel that in your home equity line for like another year, and it's still going to be somewhat elevated. So, you know, I would try to aggressively pay it down as much as possible. And actually, you know, one quick plug here for Christina, in her last article that she put out about fixed income, that's one thing that we pointed out, was that if you know, really try to pay off your home equity line if you have it. It doesn't help too much right now to kind of refinance it into a fixed loan, because even if you were to go to a 15-year fixed loan, you're probably at 5.5%. That may help a little bit. And if you have like over an 8% yield right now, or interest rate on your home equity line, that may make sense. Again, ask your advisor. But the ideal scenario is you pay that off as quickly as possible with the rates as high as they are. But if it's really bad, you may want to consider refinancing. The only problem with that is you have to pay, you know, closing costs a lot of times. And interest rates may fall down in the next year, which then you may want to refinance again and pay closing costs all over again. So consult us with your financial advisor to see what's best. But, you know, if you can, aggressively pay that down or off as quickly as possible.
Very good. Well, we've come up on the hour, so we want to thank everyone for joining us today. Remember, you'll be getting a copy of this in your inbox, hopefully the next 24. Whoa, you're getting me dizzy here, Jason. But feel free to give us a call if you have any questions about what you heard or anything else that's come up or your financial planning and you just want to do a review. We look forward to seeing you soon, and have a great day, everyone. Bye-bye now.
Thanks, everyone. Take care.